Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with two very accomplished wealth management professionals about significant changes in the family office market. Lindsey Rubinstein is a frequent speaker at CFA Society New York, and she is the senior executive responsible for marketing, investor relations, and product development and strategy for the separately managed alternatives affiliate of a New York-based family office. Previously, she was in the C-suite at American Farmland Company, a listed REIT. She also held roles at Robati and Company, Optimum Fund Management, D. Shaw Company, TIA, CREF, and Goldman Sachs. She got her bachelor's degree at Cornell. Neil Datta is also here today. He is the managing partner of NKD Advisory. Over his career, Neil has conducted due diligence on more than 2,000 funds and allocated over $9 billion across hedge funds, private equity, private credit, I should say, venture capital, and other alternative strategies. Previously, he was an MD at Forbes Family Trust Optima, where he worked with Lindsey. You may have heard that before, and a senior investment professional at Arden Asset Management. So welcome, Lindsey, and welcome, Neil.
Hi. Thanks for having us. Always a pleasure to be with the CFA Society.
Hey, Rob. Thanks for having us. Looking forward to the conversation.
And good to see you, Neil.
See you as well.
So let's start with something that I think is becoming more and more complicated all the time, and that is, what the heck is a family office? And please talk about it in the context of the organizations you're with right now. So who wants to go first?
Yeah, I'll jump in with that. And I'm just going to give everybody a poll of the audience. But as you're thinking and listening, intergenerational transfer between now and 2048 is a huge number. And I want, everybody to think about what it is. Is it 30 billion? No. Is it 30 trillion? No. It's $124 trillion. And I want you to think about, and it's funny seeing Neil, who we've worked together for a while, and we've known each other for, over a decade and probably longer, and we don't want to age ourselves, so we'll leave it at that. But even Optima, and it's one thing I joke about is, the dawn of alternatives was the 1980s. If we take a step back and do a history lesson, right, for those of you who maybe might be newer in the industry. And now, Neil and I knew each other at a hedge fund of funds, and hedge funds of funds are now essentially rebranding themselves as family offices. And it's not necessarily a misnomer. In fact, Optima became a part of a family office as they were seeking to next intergenerationally expand and institutionalize. So it's great to be here. But I would like to just say, imagine you're Scrooge McDuck, for those of you who know DuckTales, swimming through a pile of money at the pinnacle of all of your wealth. And it seems kind of awesome. And what happens is allocators, such as family offices, are often looked to for their advice and opinion. So we have the real opportunity here to form a dialogue and take it forward. And I'll quote a football player, Vince Lombardi, who said, "The man at the top of the mountain didn't fall there," right? So how did Scrooge McDuck get there? Family offices are essentially an asset aggregation of wealth, different from how the wealth was sourced, with a view of forming a legacy, preservation, and compounding of wealth from there. So now that we've taken the trip down memory lane, I think it's great to have Neil in that context. I don't know if you think the family offices are the same.
Yeah, I would say roughly the same. And I guess my definition would be that it's a legal entity that was created for the specific purpose, as you were mentioning, of both protecting and growing accumulated wealth of a particular family. What's really interesting is that when families have an alignment of interests and don't have a natural conflict of interest, it's interesting that it allows them to pool capital, share expenses, and share resources. And that's what's evolved into what I would call kind of the multifamily office concept.
Yeah. And I think we're at the moment where we're at right now is where family offices are becoming beyond a family and not even a tribe. They're institutionalizing, developing more formal processes, more formal investment structures for these legacy investments. And there's more of a focus on that, which is why, the irony of Neil and I being here, where we're in very institutional, non-specifically family office roles, are very applicable to the family office space as it's becoming multidimensional beyond a legal preservation entity.
Yeah, this is exceptionally interesting to me because I started in wealth management a long, long time ago when it was mostly family office was kind of like an accounting firm, a small one that managed the assets for one family that mostly earned the assets from either taking a company public or selling it to a competitor. Fast forward these so many years, things are a little different now. And this is one of the things I thought was exceptionally interesting about the event you all spoke at, is we talked a little bit about how family offices view the rather large expenses of attracting and retaining top talent. So I mean, how are they viewing that? How are they handling it? How are they budgeting for it? How does all that work now?
I'll start. I would say it's a challenge for sure. Generally speaking, the top investment talent in the industry is used to top end compensation that they would normally get as an employee of a hedge fund or an investment bank. And sometimes, candidly, a principal of a family office is just not equipped to do that or just not a space they're in. So there's only kind of two ways to pay for it. Choice a family has to take the responsibility of sourcing, hiring, maintaining portfolio management staff, as well as having a sufficient number of analysts and accountants and lawyers to facilitate the type of investment activities they want to scale as a family. The family is essentially making a bet that the money that's going to be generated from managing outside capital is going to be sufficient, and it's going to make the effort of building a team worthwhile. And candidly, one thing I hear from having these conversations is that not every family wants to do that. It's not everyone's interest to hire this type of team. Usually, this family, as you mentioned, Rob, they had a single source of wealth, a single liquidity event, or a single company they built, and they're not, Wall Street types, if you will. So that's really the challenge. How do they build that type of infrastructure that a family with $10 billion has at a much smaller scale? And that's where I think the multifamily office model shines.
Yeah, I agree with Neil, and I'll kind of riff off of that. It comes down to institutionalization, implementation, and integration. Picturing back to Scrooge on top of the pile of money, so much. What if there's a lack of financial literacy? There has to be the acknowledgement there's a need for a solution. I don't want to call it a problem, but a need for a solution and a need for a change, which usually comes from an incomplete skill set, right? Like, wealth comes from oil and gas or real estate, realizing that the need for a legacy probably has to be more diversified and almost a hedge to that, uncorrelated to that. And so there has to be an intentional decision that this is an area that there wants to be an investment, not necessarily revenue generating per se, but an investment into that diversification. So it has to be a conscious decision. Where there's, I would say, a lack for compensation, there's probably other ways to align incentives, right? Bringing on people at the top level and aligning incentives so they're part of the growth effort there. But once there's a decision to institutionalize and formalize an effort and attract that top of talent, and it's interesting because the industry evolves. And again, going down history lane, Neil and I both were, experienced the great financial crisis and how the industry was not prepared. And at the time it was hedge funds, private equity and private credit were not flourishing, but it was a huge focus on the illiquid bucket was like a bad thing. And it brought about the need for transparency and a lot of, NK, the plug for you, Neil, NKD advisory, and a focus on the need for operational due diligence and separation between church and state investment, portfolio risk, and ODD. All should have their separate checks and balances, right? From that, I think there's a need, from that flourished private equity and private credit. That was the solution for a liquid. And all of a sudden it's attractive in a space people want to invest in. You take the frown and turn it upside down, right? So that's what's happening is there's an intentional decision to become more of an institutional family office. You need to attract that type of top talent. You need to build those incentive structures and align them properly.
Yeah, I mean, this is one of the things I always thought was sort of fascinating about family offices is you just said a lot of things in sort of phrases that are exceptionally complicated. Went from, due diligence to building an operation to, it's hard.
Sounds easy, but if you break all of them down, they're complicated.
No, one of the other things that's often challenging, but I think is exceptionally interesting to hear at a time like this is we're recording this podcast on April 3rd, and it's been one heck of a quarter. How, with the families you work with, how have they been changing or have they been changing their asset allocation or their asset selection due to all of the stuff that we all know about?
Yeah, I mean, I can start with this one. It really depends at core what your philosophy or mission statement is as a family office. So, for example, and this kind of is akin to, how are you integrating ESG? It kind of has like very different things, and that's a whole different tangent, but very similar answer. If your core focus, the family office, which I've been aligned with for the past, several years, core focus, on the liquid side is diversify and protect and hedge and don't lose money. From that context, we kind of are agnostic to tariff day yesterday,
Right.
market shocks, and if anything, we want to be insulated from that and feel that the way we're invested is a constant perennial umbrella, right? Other family offices might have a more mission statement that's more directly aligned with beta. Beta meaning alignment with market directionality, which most people view as the S&P or the stock equity markets. So it depends on your view and mission and how you define investing in your thesis there, and then the processes inherently you build around that to protect against that or invest in a diversify, holistic manner against it.
So I work mostly with large offshore families. And one thing I quickly realized is that it doesn't really matter if the family is based in London or Singapore or Mumbai. Every one of these families has significant exposure to the US market, significant exposure to US dollar assets such as real estate, infrastructure, credit, debt. And I talk to these principals on a daily basis, and I hear the same things over and over again. They're worried about valuations, they're worried about liquidity, they're worried about just generally the kind of where we are in the current cycle. And the way we're responding is really taking more of a data science and quantitative approach, such that every decision that we make for these families is driven by information arbitrage, gathering intelligence, incorporating that intelligence with legacy data. And a lot of times, this is where families come in really, really valuable from the perspective of a lot of times there's families who've been doing one thing really well for generations. And as an investor, you're able to kind of extrapolate that knowledge and make investment decisions based upon this legacy intelligence. And to answer your question, the systematic changes we're making are more similar to what we were saying earlier, in the sense that family offices are behaving like hedge funds. They're thinking about stress testing their portfolios. They're thinking about hedging. They're thinking about correlations and cross correlations. And really the end result of that is that they're going from the kind of single liquidity event or the single source of wealth which made them their money, and they're converting that into an all-weather portfolio to protect and preserve their wealth.
Okay. So yeah, I mean, this is refreshing because it's exceptionally long term, right? It is, which is something that is missing from a lot of the dialogue right now. I guess I'd like to shift this a little bit because anytime there's a massive bifurcation in the market, which you also have, is a set of opportunities that opens for people with liquid cash and cool heads. So what are your family seeing right now in terms of those things? Have you seen any interesting opportunities open up?
I'm happy to start. One area that we continue to be bullish on is private credit. I think all the macro tailwinds for private credit have been obvious for a while. The 75% reduction in regional banks, combined with the fact that 99% of businesses in America are small businesses, and they roughly employ 50% of the emerging American workforce. So that area of the market is basically unfinanced by traditional banking. And what actually happened was private credit was initially a source of last resort capital. And that changed. They became the kind of first resort. And what that means for investors is that there's return compression. So we've seen tons of capital, hundreds of billions of dollars flow into private credit over the past 24 months. And you can pick any one of these large managers. A lot of these managers have grown 2x or 3x over the past 36 months. And that has just normally led to return compression. And the area that we think is interesting from an opportunity set is going lower in the market. So, and this is, I think, a relatively new space, because if you think of practically from a diligence perspective, a large private equity company or a large growth capital company has to spend the same amount of time and resources and man hours to diligence a $100 million deal and a $1 million deal. Right. So it just didn't make sense for them to do those smaller deals. Right. But what's changed now is the advent of agentic diligence and AI and machine learning. My team is able to do this in a way that candidly wasn't possible 6 months ago. And that's what I'm really bullish about and excited about, is the ability to kind of create portfolios with these instruments that were generally uninvestable from an institutional standpoint, and the really interesting outcomes that you get from using different ingredients in your portfolio.
What size deals are we talking about here? Is there a general
Yeah,
number
I
we're
mean,
looking at?
honestly, we're looking at deals as small as $3,000.
What?
So
Okay.
imagine a portfolio of hundreds of line items of $3 to $10 to $20,000. That for example, like I'm talking about litigation
Yeah,
finance,
yeah,
for
sure.
example.
Mhm.
So we're buying a case that has a $3,000 to $5,000 upfront cost, where the outcome is a $20,000 or $50,000 outcome. So where we can reasonably 10x our money in a reliable amount of time. And the key distinction is that the only way we play in the space is that we have tons of data. So we know quite reliably that if you have this circumstances, A plus B plus C, we know that equals $150,000 in 17 months. So that's how we make our decisions, and that's how we build our portfolios.
So have you looked at anything along the lines of what you get in terms of diversification out of so many small deals that are essentially in wildly different subsectors?
It's fascinating, because if you think of from Lindsey and I were both his institutional LPs, and from the LP perspective, you're talking about a investment experience where historically you've had a 5, 7, 10-year lockup, and you're hoping and praying for double-digit returns. And all the macro tailwinds that have driven money into private credit. What if some of that money goes lower in the market? And to your point, by taking smaller bite-sized deals and staggering their liquidity in a reliable fashion, you're able to offer your investors, LPs, quarterly subs and reds. So you get a better return experience, which I think
Right.
is 50% better returns
Uh-huh.
and quarterly liquidity.
Right, which you're not going to get anywhere else, and
And
you
you
don't have
can't.
and you have a big lockup either.
And maybe the icing on the cake is effectively zero equity market correlation. So a consistent non-correlated return stream, which almost every family office would appreciate.
On the private equity side, yes, what's happened over the past several years, as there's been this denominator effect with the pension plans, which means that they're stuck with private equity, which becomes a larger inherent exposure because there aren't liquidity effects. So it's a larger exposure on their books, and these funds are trying to raise subsequent funds. It provides an attractive opportunity, as Neil was alluding to, for those to invest in on the family office space. Why? Why is this attractive? Family offices inherently are more tend to be. I don't want to, family offices are like Forrest Gump. Life is like a box of chocolates. Each family office is a different chocolate, but tend to be more nimble in their ability to asset. Do tend to benefit from intellectual arbitrage and sharing of ideas in safe spaces and communities, can aggregate their capital towards a group idea. But what's happened in private equity is you get a better look-see into their booksy, basically. Inherently, when there was a rat race to invest in private equity and you had to put in because the fund was closing, it might have been a blind pool pipeline, and you just had to trust the relationship currency that they were going to invest well. Now you get to see how managements act in this environment. Are they panicked? Are they frenetic? Are they stayed in their ways? Whose C-levels are changing managements and who's staying the course, right? And it gives you time to see and negotiate better potential terms. On the LitFi side, it's truly uncorrelated. I like it because people fight in good times. People fight more in bad times. And if it's done correctly, a litigation finance firm, instead of having like a me and a Neil there, or a CIO, they hired the best litigation teams to be the analysts and dissect the cases for a probability potentially of settlement before an expensive trial, and put together diversified portfolios of legal cases. Other attractive spaces, that have come out of it, or the ability to seize upon this massive land grab at the intergenerational transfer. Everybody wants the solution for the $124 trillion. And what we're seeing is financial services and entities, other large conglomerates with massive M&A transactions. One, to try to build upon the fact that 2022, when equity markets had a very big down year, and so did bond markets, this notion of this heavily relied upon and often stayed FA rule of 60-40 fractured. We don't want to call it broken, but there's almost a universal acknowledgement there's a need to diversify into alternatives, and many were late to the game. And that's what they're trying to cure with massive M&A. So there are actually opportunities, and there are entities out there that are investing in minority stakes in these entities, which is also uncorrelated and takes an agnostic view on it doesn't matter who wins or loses in the M&A, but sees that this is a fundamental shift in the industry. And I think part of the distinction on the opportunity is defining what's a fad versus what's a fundamental shift.
Yes. Yeah. That is always the challenge, right? Yeah. It's exceptionally interesting. Well, thank you for that. That is fascinating. So, thank you both for being here. This is a great rundown on what a family office is and where you see value now. I can only say this, when we have bifurcation in the markets, someone's going to make a killing. It might as well be us. So thank you both for being here.
Thanks, Rob.
Thank you. Thank you for having us.
And thanks to you all for listening in. If you're a member of CFA Society in New York and like to hear some similar ideas to this, please sign up for the 6th Annual Endowment and Foundation Roundtable that we have coming up on June 5th. Just before this podcast, we were talking about how similar endowment and foundation overall views are to family offices. So maybe you'll get something out of this. Their flexibility in foundations and ranges are about the same. So until next time, I'm Rob Rowan, and this has been Compound Insights.